Happy Memorial Day. We have a happy surprise. Rates, mortgage rates, long-term rates, which everyone knew were going to go up. We should be at 5 now. All of a sudden fell. They fell all week, and today, Friday before Memorial Day weekend, the big shots in New York are already out in the Hamptons kicking sand at weaklings. I mean, nothing is supposed to happen on a day like today. Markets close early. And instead, we're the lowest that we've been. We're as close to the lows of the last 4 or 5 months. Mortgage rates are, we find them under 4.75. Likely not a trend change, but why this has taken place, I mean, in some ways it's so odd that it's hard to describe, and it's hard to list all of the surprises which took place. One of the surprises, first thing this morning, the Saudis and even the Russians announced that they would ease up on oil supplies. Great. That keeps the price from rising above 80 bucks, reduces some inflation threat. Why would they do that? The Saudis have known for a long time that high oil prices breed competition, more supply, and more conservation. So they would much rather keep us hooked on the juice and keep prices low and affordable. The Trump administration from time to time is a fountain of surprises. The North Korean deal, it makes the investment world nervous. The safe place to go if you're nervous is to buy bonds, and especially to buy treasury bonds, and so the world has. The trade wars that we have going intermittently or resolving or starting new ones also make everybody nervous. This week's announcement that we're going to slap a tariff on imported automobiles, nobody likes it. Bipartisan does not like it. Another player in the game is the whole outside world, which every day is bigger than it used to be relative to the United States. Europe, theoretically doing well. This week, the most significant piece of economic data from Europe hit an 18-month low. I mean, just flat tanked. The European Central Bank, which is supposed to begin to remove its emergency easing and help Europe recover, our Fed now has an overnight cost of money of 1.75, going to 2 in mid-June. The European Central Bank's overnight cost of money is still negative 0.4%. The European recovery may fizzle. Another European player is, gotta love them, Italy is returning to being Italy. So we saw, especially today, the yield on German bonds going straight down. It's fallen by 1/3 in 10 days, which tends to pull down our yields. It's all just one big market for investors. Meanwhile, the yield on Italian bonds has soared. The yield on an Italian 10-year IOU is now, do the math, 6 times the yield on a German 10-year. Same currency, same central bank. So uncertainty, concern in Europe for its recovery pushes money in our direction. The last player this week is the Fed. The Fed, a few weeks after each meeting, releases the minutes of the meeting, and they're frequently misunderstood. There were a gale of people this week who thought that the Fed is too easy, and so rates are coming down. There's another big group who thinks Fed's too tight, so rates are coming down, anticipating a recession. No. The Fed's playing it straight. The second quarter of 2018, GDP is going to grow somewhere between 3.5% and 4%. Best in the world. Next Friday, we get employment data for the month of May. That data is going to be good. It's not going to be bad. So the decline that we saw during the week this week, that's taken mortgages back down to 4 3/4 or so, odds heavily favor temporary, may begin to reverse itself as early as Tuesday. Thinking about locking in interest rate, get it done before next Friday. And the largest story coming at us will be the next Fed meeting and how financial markets react to this next hike, changing the relationship of other rates, which is predictive to us. The way spreads change after the Fed actually acts is instructive. Thought that the Fed would hike 4 times this year instead of 3, nah, They did it once early this year. They're going to do it this month, next month, and again sometime in the fall. But the Fed is just watching economic data as it comes in. But its intention is this very slow, steady, predictable, relatively safe return to a reasonable relationship with inflation, rather than the emergency assistance that we've had since 2008. So, take good news while you got it. Have a great Memorial Day.